What's actually kind of fun right now because of the market uncertainty, the pessimism, the volatility, interest rates are up. In many parts of the country, you've got falling rents, not the Midwest, rising insurance costs in areas where they have hurricanes and other issues, and rising property taxes in some of these areas. It's created this perfect storm of pessimism for multifamily. What's been great is here in the Midwest, we don't have falling rents. We have rising rents. The Midwest doesn't boom, but it doesn't bust either. And insurance is still relatively cheap compared to most of the country. Property taxes are doing fine. Indiana actually just ranked like 4th in the country for its property tax environment. And so, yes, we still have interest rates rising, but we've got a great lending partner who's been doing this for 40 years. They're a publicly traded bank. They've got a big multifamily arm. They're quite healthy and quite good shape, and they still love loaning on large multifamily. They don't loan on office, they don't loan on industrial, they loan on multifamily. And so we've got a great lender who's our biggest investor. And then aside from that, there's very few or a reduced amount of buyers in the marketplace. Indianapolis, I have not been able to buy a deal in the suburbs of Indianapolis in over 2 years, maybe almost 3 now. And primarily that was because institutions could come in, and institutions who might only need a 10% return, when my BAM investors are looking for that 20+% return, well, do the math, the institutional investor can pay a lot more than I can. So we would get smoked, absolutely outbid on these institutional Class A value add multifamily that we're buying. Institutions have an asset allocation problem right now, which is forcing them on the sidelines. They bought long dated treasuries, 10-year, whatever, longer, but they bought a lot of bonds when interest rates were very low. And as interest rates have risen, the value of those bonds has dramatically decreased. You can't add value to a bond. It is what it is, it's a contractual obligation. And if you bought a bunch of low interest rate bonds and interest rates go up, the value of your bond goes down. So if the institution has a mandate, we're only going to own 15% in multifamily real estate, and the value of their portfolio overall has gone down, well, now they might already own 15%, 20% of multifamily. So they're unable to buy. So in some of these cases where we're looking at an asset to acquire, the field of buyers has shrunk to only just a handful of groups that can get the financing. And so that can affect pricing as well. And so we're seeing this window of opportunity in the market to pick up some great deals. It reminds me of the first few months of COVID-19 when we all locked down back in March, April, May of 2020. The very beginning of lockdown, you might remember, everybody thought real estate was going to crash. Everyone thought no one was going to pay rents, the world was coming to an end. And institutions at that time were not getting on a plane and flying around and looking for real estate to buy. Well, my partner and I put our hand up and we bought some of the best deals in our careers. And right now, it smells like that again. We've got a buyer's window where it's just a little bit easier to find a deal.